Marcel Brandenburg is joining us here in studio. Hey Marcel, nice to see you. You're in Sydney. It's sort of fortuitous. So we were just talking about a company that grew its quarterly revenue by 17%, but I noticed that Good Drink Australia revenue for the half year was up 80%. It's pretty stellar. What's behind that?
Yeah, look, thanks Nadine. Look, we're really pleased with those results, as you can imagine. It's been a really strong half for us, and really what we're seeing is, for the first time, we've got two new earning streams that have been added to our business. We've always historically sold our own brands like Gage Roads and Matzo's, and recently we've done a deal where we now sell big international beer brands as well, like Miller Chill, Coors, Magnus Cider, and that, together with the introduction of our hospitality segment or business unit, has really delivered a really strong result. So in that hospitality segment, we've seen for the first time the full earnings that our flagship venue in Fremantle can create for the Gage Roads brand. I think last time we spoke, I was broadcasting from there, and then also our venues here in Redfern and on the Sunshine Coast for Matzo's. So that's been a great result for us, and we're really happy that we've now got these diversified earning streams.
Yeah. So does that sort of, in a way, well, you're obviously benefiting from people getting out and spending on services, wanting to get out and about and spend that money. Does it also sort of offer, a little bit of a buffer if you see one segment of the business potentially slow down? As I hate to be the bummer, but as we see, the economy slow, potentially we're talking about a hard landing, with the interest rate rises to come.
Absolutely, and this is actually one of our key competitive advantages. We've got a very diversified portfolio, and we play in multiple parts of the market. So we're not just in beer, we're also, or craft beer, we're also in cider, we're also in salsa, we're also in RTDs, and within those segments, we've got quite a diversified portfolio range. So that certainly helps us smooth out the bumps. The other things that really helps us is the scale that we have both in our manufacturing, because it keeps the cost down and it allows us to put a pretty compelling shelf product in for a good shelf price. Yeah.
Now craft beers are all, it's where it's at right now, right? There's a lot of them out there, all competing for the same market. Are you worried at all that the preference might change away from craft? How do you make sure that you stay with what consumers want? How do you make sure you're the brands that people are interested in?
Yeah, look, it's a valid point. It is a very dynamic marketplace, that's for sure. I think what we are starting to see is a consolidation. I think the shelves are now so full of different brands that it's making it really difficult for the shopper to actually find what they want. So I think there's going to be some consolidation there, and I think leading brands like our Gage Roads Single Fin and our Matzo's Ginger Beer are really well placed to dominate in those spaces. And then the other thing is that we've got a very capable sales and marketing machine that can generate new brands and can identify segments that are in growth and finds out where the consumer trends are, and we can meet those needs pretty quickly, and we can get it to market pretty rapidly.
Okay, when we think about where to from here, so you want to grow earnings, you're the numbers man. You want to grow earnings by what, by when?
We need to grow to $25 million in EBITDA by FY25. We've got a fairly well articulated and clear pathway how to get there, and it is using those three earning streams. It's basically growing our core business of selling our existing brands by around 15% growth year on year. It is maintaining these partner brands that we've onboarded during the year, and then it's also introducing another 2 venues into our hospitality segment, and that's going to deliver us between $25 and $30 million in EBITDA.
Okay, so you've put a timeline on it. What needs to go right? So I know that we've talked about the levers that you can pull, but how about costs? How do you keep costs under control? Do you have any problems with inventories? Because beer does expire, and alcohol in general. So how do you sort of manage strategically the other sort of, away from brand, away from product?
Yeah, look, I'll answer that in 2 ways. We are in the fast-moving consumer good category, right? So our products that are flying are actually turning over really fast. So we don't really have too much sort of stock on hand. Beer also has a pretty long shelf life of about 12 months, so that helps.
Can I interrupt? Can you drink beer once it's expired?
You can. You wouldn't taste great.
Okay.
It wouldn't taste great.
Okay. Sorry, I interrupted.
No, that's okay. And then on the cost side of things, despite the fact that our brands are in really good growth and we've got all these new earning streams coming online, we are going through some cost efficiency
Yeah.
measures at the moment, and that's really just to make sure that our earnings land in the target range that we've set for ourselves.
Okay, so if I'm a shareholder, look, it hasn't been a terrible performance, but like I'm looking for a next catalyst to sort of move the share price higher from here in terms of capital gains. What might that be?
Look, for us, it's continued performance, strong earnings. We are a business that should be based on fundamentals. We are an earnings generating and cash generating business. The next big, lookout for us would be just a continued growth of our existing brands, and also once we bring in these new venues online, again, they're going to be material earnings changes for us as well.
So you, as the CFO, do you go around to all these different venues, make sure everything's ticking along as possible as it should be?
I do.
Lucky you.
Yeah, I know, and you're welcome to visit all of them.
Well,
Nadine.
thank you.